In the autumn of 2008, something happened that millions of Americans believed could never happen. Trusted financial institutions collapsed. Household names disappeared. Retirement accounts that had taken decades to build suddenly seemed fragile. For many retirees, it felt as if the financial world itself was breaking apart. The fear was unlike anything they had experienced before. And perhaps the most surprising part is that the greatest damage was not always caused by the market decline itself. It was caused by what happened next, the decisions people made while they were afraid. Today, when people look back at the financial crisis of 2008, they often focus on numbers. The stock market fell, banks failed, homes lost value. But numbers never tell the full story, because behind every chart was a person, a retired teacher, a factory worker, a small business owner, someone who had spent decades saving and planning for a future that suddenly looked uncertain. Imagine waking up each morning and seeing headlines predicting disaster. Imagine watching news anchors discuss the possibility of financial collapse. Imagine opening your retirement account and discovering that years of hard work had seemingly disappeared in a matter of months. Most people believe they know how they would react. History suggests otherwise. Fear changes behavior, even among intelligent people. Especially among intelligent people, because fear is not a lack of intelligence. Fear is a human response to uncertainty. And uncertainty was everywhere in 2008. At the beginning of the crisis, many investors believed the decline would be temporary. Then the losses continued. More bad news arrived. More institutions struggled. More headlines appeared. What started as concern gradually became panic. And that panic created a second crisis, a behavioral crisis. Millions of investors abandoned long-term plans. Some moved entirely to cash. Others sold investments after substantial losses had already occurred. Many simply wanted the emotional pain to stop. The problem was that emotional relief and financial success were not always the same thing. This is where one of the most important lessons from 2008 begins. The market eventually recovered, but many investors who sold during the worst moments never fully participated in that recovery, not because they lacked opportunity, because they lacked confidence. Fear kept them on the sidelines. And this is a pattern that appears throughout financial history. People often believe the hardest part of investing is surviving a crash. Historically, the harder challenge is returning after the crash, because once fear enters the decision-making process, every future decision becomes more difficult. This is something that fascinated Jack Bogle for decades. Bogle understood that successful investing was rarely about predicting the future. It was about managing behavior. Again and again, he observed the same cycle. Markets rise. Confidence grows. Markets fall. Fear grows. Investors react emotionally. And long-term results suffer. What made 2008 different was the scale. The crisis was so severe that even disciplined investors questioned assumptions they had held for years. For retirees, the situation felt particularly dangerous. A younger investor might believe they had decades to recover. A retiree often viewed the situation through a different lens. What if the recovery took too long? What if losses became permanent? What if retirement plans no longer worked? These questions were reasonable, but they also created enormous emotional pressure. And under pressure, people naturally seek certainty. The problem is that financial markets rarely provide certainty. That is why many retirees made decisions that felt safe at the time, but later proved costly. Some abandoned diversified portfolios. Some stopped investing entirely. Some held excessive amounts of cash for years. The intention was protection. The result was often missed opportunity. One of the least discussed consequences of financial fear is how it changes perception. When people are calm, they evaluate risks logically. When people are afraid, they often see danger everywhere. A normal market fluctuation feels catastrophic. A temporary decline feels permanent. A headline becomes a prediction. And this is exactly why emotional investing can be so destructive, because fear narrows perspective. It focuses attention on immediate discomfort while hiding long-term consequences. The investors who navigated 2008 most successfully were not necessarily the smartest. They were often the most disciplined. They understood something that history has repeatedly demonstrated. Temporary fear and permanent decisions are a dangerous combination. When emotions become extreme, patience becomes valuable, not because patience eliminates risk, because patience prevents unnecessary mistakes. This principle appears again and again throughout financial history. It appeared during the Great Depression. It appeared during the inflation crises of the 1970s. It appeared during the dot-com collapse. And it appeared once again in 2008, different events, different headlines, the same human psychology. That is why the lesson of 2008 remains relevant today. The crisis itself ended. Human nature did not. Fear still influences decisions. Headlines still create anxiety. Market declines still trigger emotional reactions. And retirees still face the challenge of balancing caution with long-term growth. The goal is not to eliminate fear. That is impossible. The goal is to understand it. Because once fear is understood, it becomes easier to prevent it from controlling financial decisions. Jack Bogle often reminded investors that simplicity has power. Not because simple strategies are exciting, because they are easier to maintain during difficult periods. A complicated strategy may look impressive during good times. A simple strategy is often easier to trust during bad times, and trust matters when uncertainty arrives. The real lesson of 2008 was never about banks. It was never about headlines. And it was never about predicting the next crisis. The real lesson was behavioral. It revealed how people respond when confidence disappears. It showed the difference between reacting emotionally and responding thoughtfully. And it demonstrated that long-term financial success often depends less on market conditions and more on personal discipline. Today, many retirees still worry about the next downturn. That concern is understandable, but history offers reassurance. Every major crisis has felt unique. Every major crisis has seemed frightening. And every major crisis has tested investors emotionally. Yet, time and again, disciplined investors have discovered the same truth. Fear is temporary. Sound principles endure. And perhaps that is the most valuable lesson 2008 left behind. Financial markets will continue to experience uncertainty. Headlines will continue to create concern. Predictions will continue to change. But the principles that helped investors survive difficult periods remain remarkably consistent. Patience, diversification, simplicity, and emotional discipline. Because wealth is not usually destroyed by a single bad headline. More often it is damaged by emotional decisions made during moments of fear. And just as fear can spread quietly through a portfolio, confidence can return quietly as well. One disciplined decision at a time. One calm choice at a time, 1 year at a time. The crisis of 2008 taught retirees many lessons. But perhaps the most important lesson was this. The greatest threat to long-term wealth is not always the market itself. Sometimes it is the fear we feel when the market tests our confidence.